Managing your risk as a trader is one of those skills that take quite a long time to nail all on your own. It's not sexy, it's not exciting, it doesn't make you feel like you're on top of the world, but at the same time, to make serious cash out of this, you have to learn to become a very good loser. It sounds counterintuitive. How can you make money if you focus on being a good loser? It's because the big secret in being consistently profitable is not how
quickly you can make profits.
It's actually how controlled your losses are. So in that vein, today I want to talk to you about averaging into trades. This is one of the questions that I get a lot, usually from people who have not really watched me trade live here on my daily YouTube live streams for members. D, do you average in? D, should I average in? D, how do I start averaging in? So let me start by saying that averaging into a trade as a retail trader is quite possibly one of the worst trading sins that you can commit, especially when you're doing it in a completely unstructured way, which is mostly the case, right? Just randomly kind of doubling down when the trade goes against you. Now, this was a strategy that used to be done by those like dodgy signal services back in the day. They were everywhere with their like 100% hit rate. But what they were doing is that they were actually taking advantage of this doubling down strategy and trading without any stops. So the idea was that the market would turn around in their favor at some point and they would end up in profit. So that way it sort of looked like they never lost a trade. But if you looked at their open equity curve, it was a fucking disaster. Going into like 90% of drawdown or blowing the account, obviously. But when you looked at their closed equity, which is what a lot of these signal services were doing at the time, it legit looked like they had like a hit rate of 100%. But I digress. The real question here is there an appropriate time to actually start averaging in? Is there any benefit to it? Well, the only time averaging in starts to become useful is when a professional trader reaches a point of trading with size, with a lot of contracts. Now, this is not such a big problem for like a thick market such as ES futures, unless you're trading like crazy institutional sizes. But executing position in some thinner markets such as GC, gold futures, and CL, which is crude oil futures, well, it starts to become a problem already over about 30-40 contract size. And you will find that you're not always going to be able to fill the entire position all in one go. In that case, averaging in it will definitely become something that you will have to deal with. But most traders will take many years before they actually get to that point, if ever. A lot of people who make serious cash and living out of prop trading, they only trade with about like 4 to 5 contracts at most. 4 contract size and 2R multiples in profit is just under $3,000 per trade. But when people ask me, oh, hey, should I average in? And they're only starting to trade with 1 micro lot, the answer is categorically no. It means that you first need to focus on improving your entries, especially if the reason why you're asking about averaging in is because your trades are constantly suffering like a 30-tick drawdown, or you're constantly losing, or you're trading without stop losses in a completely unstructured way. That means your trade locations and timing need work. Averaging in is not going to solve that. In fact, it's going to make everything a lot worse for you. But once you get to a point where you're extremely skilled and you get to the point where you're trading with multiple contracts, then it won't be a matter of doubling down because you'll still have the default position size that you're aiming for. Now, the way the futures market execution rules are and the way clearing houses work is that they favor smaller contract fills first. So if you're trying to go in with like 150 contracts in one go on crude oil, that's not going to happen. You're either going to get an order rejected, or if you have the setting to kind of like partial fills, you might get an initial fill of maybe like 6 contracts, then maybe another 2, then maybe another 7. Now at that point, averaging in becomes crucial. So on one side, we have the retail trader mindlessly doubling down in panic, doubling, tripling, quadrupling their exposure with every single contract that they enter. in a misguided attempt of trying to recover the trade. And then on the other side, you have a pro trader who is simply using this averaging in to fill their entire default position. Trying to emulate this pro trader when you're only trading one single contract, it's not the way to do it. But if you do want to practice something like this in an effort to get used to this because you're at that point of your journey, well, the smallest position size that you should have is about 3 or 4 micro contracts. And you would always look at any level, orientation level that you're using for entry, not as a single price point, but rather as a zone. Now that way, with 4 micros, which again, you probably still need quite a lot of cash for. If you're just trading by yourself, you're not going to the prop firms, you would need about $75,000 in working capital. That's like the bare minimum to make it safe in order to trade 4 micro contracts. But the way to average in would be to split your zone of interest. Let's say it's a long trade. So your one contract would sit maybe at the actual price reference point, and then another one maybe 15 ticks lower, and then another 1 or 2 contracts higher, just in case that the market starts moving and you're not in with your entire position size. Because if you're not in with your entire position size and you're messing around with that, it's actually going to skew your risk model and your results completely. It's actually one of those things that can completely break a great trading approach due to positioning inconsistencies. So whatever you're doing, caution is advised when averaging in. Because what good is it to have a trade that goes to like 3R multiples if you're only in with 1/3 of your position? That's not even going to cover one loss that you made with the full position. Now, because of all of this, I really have to say, guys and gals, please don't mess around with averaging in. Instead, work on your other skills, getting the trade locations and timing of them better. All in or all out to begin with, okay? And then, once you start to get consistent with that approach, we can talk about optimizing other things that eventually come with pro trader territory. But to make things simple, just stay away from doubling down, okay? Now, if you want to hear a story about one of my first traders and how we solved some of her trading gremlins, then you may want to watch this video.